All right, this channel has finally broken 100 subscribers. By the time I'm posting this, we're a few over that. It's exciting, and so we're going to do something a little special. If you haven't subscribed to the channel yet, I hope to earn that choice from you. Stick around. All right, to celebrate, I'm going to do a full portfolio review on my main portfolio, which is my traditional IRA, my main account that I use for stock picking and trading. And so you can see that I'm in M1 Finance, and you can see my total balance. I'm going to go ahead and share all the different information with you. You can see that I began this portfolio in 2018. I don't know if you can read it on the screen there, but you can see that even though the market has really dropped this year, I'm actually still in the green on my overall portfolio investments. But I'm going to go through all the positions, and you're going to see that for the most part, all my stocks are down. But this is going to be an interesting review, I think. I'm going to go through each of my positions and talk about why I have them and where they stand. I've blurred out the information right now just to keep it a little more interesting. I'm going to reveal them one by one as I talk through the different stocks. So this is my actual traditional IRA retirement fund. This is real money, and it's my largest fund, and it's the one that I do most of my trading in. If you look, my balance in November reached its peak at just under 160,000. So I'm actually down nearly 50% from that time. But even being down that much, my net gain is still up $3,000. You'll see as we're looking through the portfolio, some of the percentages look a little bit crazy, look a little bit deceiving, both to the positive side and the negative side. And I'll point out a couple of those, not going to go over it too much, but that has to do with the different ways your brokerage may report the returns. They may use time-weighted returns, they may use money-weighted returns, and I think there's even another one beyond that. Really, at the end of the day, what do I care about? I care about dollars. So, is my position up or down? Is my account up or down? That's what I care about. So I had previously decided that I wanted to do a portfolio review and even make it part of my regular content that I'm sharing, but it doesn't really make sense to reveal that right at the beginning when you don't even have any people following you. And so now with 100 subscribers, I plan to go ahead and at least do an initial video. If you would like to see this on a regular basis, go ahead and like this video. When this video gets to 100 likes, I will start making it a part of my regular content. And if everyone likes this kind of content, I would probably make it a consistent part of my content schedule, either doing it every 100 subscribers for the next little while, or every 1,000 subscribers after that, or making it once a week or once a month or something like that. It really depends on what's going on in the market and what's going on in my portfolio. Sometimes I may go a long time without really doing much changing in the stocks that I'm invested in, and other times I may be changing things frequently depending on the situation. So a few details you need to know going in, and I won't do this each time I do a review, but I feel like these details are pretty important to understand kind of the ground rules for understanding this portfolio. Number one, I don't contribute to this fund anymore. So it's essentially a closed fund. I contributed the money from my other retirement accounts into this one, and now I trade stocks within this fund without adding any new capital. And there's a couple of reasons for that. For one, now I contribute to my Roth IRA. And so if you don't know the difference between traditional IRA and a Roth IRA, I go through the differences in the strategy that I'm using as far as traditional versus Roth in one of my other videos, and I'll put it in the corner right now in case you're interested. The other reason that I'll do this, not very many YouTubers will show you their actual portfolio, but when they do, you don't know how much are they contributing and how often and how much of their returns are really based on what they're contributing. It's really hard to get a measurement, a true measurement of what kind of performance they're getting just based on their decisions. And so I decided back before this year started that I wasn't going to contribute another dollar to this account, and I was going to use it as a way to measure my actual returns. And so again, even though the percentages may be deceiving, at the end of the day, at the end of the month, or at the end of the year, we can look at the total value of this fund and you'll be able to see the actual returns that I'm getting through my investing. Another thing I'll go ahead and point out, this fund at this point is hyper focused. It's only 11 stocks. And that's not normal for me, but that's a decision based on how the stock market is right now. I've consolidated my capital into the stocks that I feel the strongest about, and I actually kind of like this. I think for me personally, it's a good way to stay hyper focused and put my money to work on my best ideas, the things that I'm the most convicted to believe in, and so I'm going to try to keep that number small. Another thing to understand is this is a retirement account, and what that means is as long as I don't cash the money out of the account itself, I can buy and sell and trade these stocks with no tax implications. And because M1 does no trade fees and fractional shares, that means I can sell my entire portfolio today and buy all the same stocks back tomorrow. And except for the change in price between those transactions, there is nothing that's holding me back. There's no friction, there's no penalty, there's no reason that I have to hold any of these at any point. Now, depending on your situation, you might be completely different. Your account might be completely different. So keep that in mind. And finally, last one, I promise. I'm just mentioning I'm not a full-time YouTuber. So I don't have the bandwidth. I don't have the time to constantly be updating people about the changes that I make in my portfolio. So whenever I make a video, whether it's this one or others in the future or even in the past, it's what I'm thinking and doing right then. It's what I'm owning or buying or selling or researching right when I make that video. And the decision to buy or hold or sell could change tomorrow. So please, you hear YouTubers in the finance space say it all the time, but I really truly mean it. Don't copy what I'm doing. Don't copy this portfolio. You shouldn't copy anyone. Instead, learn the strategies. Learn to think the way that we're thinking. Learn to think for yourself and reason for yourself and research for yourself and make your own decisions. That's going to serve you so much better, and you're going to have much better returns in your portfolio. When you learn to think for yourself and make your own decisions, you're going to sleep better at night. All right, so without further ado, let's go. We're going to start with stock number 11. It's a tiny amount at 0.3% of my portfolio with total value of only $311 at this point. This is Vale. I would want to say Vale, but I don't think that's right. It is the largest iron ore and nickel producer in the world. And with all the commodity demands on minerals and metals, with the transition to electric everything, the demand should continue to push the prices and profit margins up for this company for a long time, I believe. Although I like Lithium Americas for their lithium, I wanted to start investing in Vale for their assortment in the other metals that are going to be in high demand. They produce iron ore, nickel, copper, and cobalt. In May, Vale confirmed a deal with Tesla to supply low-carbon nickel. You can see from this chart that I owned it for a while and invested in it. I actually sold it out in January of this year, and then I've just decided to start building a position again. I just started buying this past week, just buying $50 at a time here or there to gradually build the position. So this is one of those situations where no, I have not got a 39% return on the stocks that I own right now. I've made money on Vale in the past. Okay, so you can see that my average share price of the 21 shares that I own right now is $14.10, and today's price is $14.63. So if we go to my holdings page, you can actually see that so far I'm up 3% on the stocks that I own right now, and that's the way to understand where that position is right now. If you look up their stats, their PE ratio is incredibly low. If you look here on M1 Finance, it lists it as 3.4. And if you're used to growth stocks like I am, you would question the decimal there. Like, shouldn't that be a 34? I'm used to looking at stocks that are in the 20s, 30s, 40s. Well, it's important to know that in this industry, that's actually very common to see very low PE ratios. And so you don't need to be scared of that. You need to have perspective when you're looking at metrics like that. You can see here that M1 has the dividend yield listed at 14.33%. I've seen it listed as 10 point something, 12 point something. Of course, that's going to fluctuate with the price changes as well. At the end of the day, I don't invest for dividends. But if you'd like to pay me a dividend while I own the stock, I'm quite happy to take it, and I look at it as a cherry on top. I'm never making the decision to invest based on the dividend itself. But Vale is doing three things that I really like right now. They're paying a dividend, which shows you that they're confident, they have strong cash flow, they're rewarding their shareholders, but then they're also buying back shares very aggressively. Just this April, they began a plan to buy back 500 million shares in just 18 months. And they're paying down their debt. They plan to have a net debt of zero in 2023. So those are all signs that the company is healthy and strong and making some good decisions that are going to benefit shareholders in the future. And personally, I believe that this market is just going to continue to have outsized demand for years to come. I think mining companies are really going to struggle to produce as much to meet the demand as people are going to have over the coming couple decades. So while this position is tiny, it's brand new, and I plan to add to it more over time, and I'll gradually grow it into at least a couple percent in my portfolio. All right, next up is Stone. This is stock number 10 on our list, counting down to number 1, and it's about double the position size here. And Stone, if you're not familiar with it, this is a financial services business headquartered in the Cayman Islands, and their main market is Brazil. It serves small and medium-sized merchants, both brick and mortar and online vendors, by providing all kinds of financial service tools through their 260 integrated partners. I found out about Stone when the stock dropped sharply after they had some bad news come out, and I watched a video where someone discussed how this stock was owned by both Warren Buffett and Cathie Wood. And as you can imagine, the list of stocks that would fit in both of their portfolios is pretty small, so it got my attention. And I didn't do a tremendous amount of research. It's not something I'm interested in owning a huge percentage of my portfolio in, but it was something I thought I would invest a small amount in, and I'd like to hold it for a little while and see how it does. There's a couple of reasons for that. Number one is because the stock fell so dramatically through the bad news and the bad timing with the overall market going down and everything like that. It fell so hard, I thought I'm going to scoop up just 100 shares. And so I bought 100 shares at an average price of $11.19. And so I'm down right now. If we go back to my holdings, I'm down about 31% on my position. But as I said, it's a small position and I'm interested in holding it for a long time. And the stock itself, if you will go back and look at its all-time high, is up around $93, $94 a share. I don't know if it will ever get up that high again, but I'm interested in watching to see how it plays out. So I think of this stock as being like the square or the block stock for Brazil and or South America. All right, we got to keep moving. This video is going to get really long. Okay, stock number 9 is Coin. If you've been on my channel very much, you've probably seen some videos about Coinbase. And you can see here's another example where the reporting looks just absolutely crazy. I'm not really down 97% on this position. And really honestly, I haven't added any Coinbase shares in quite a while. Coinbase is the American leader of cryptocurrency exchanges right now, has been for a long time. And you can see that I've been investing in Coinbase for quite a while, and I've varied the amount that I'm invested in it depending on what's going on at the time. My average share price is $176, and right now it's trading at 47. So yes, I am drastically down. If we go back to the holdings and take a peek on the shares that I own right now, I'm down 73%, which is terrible. It hurts, and I'm glad that at this point I only own 30 shares, and I had drastically reduced my position before it fell so much. All right, so there's a lot of news about Coinbase. There's a lot of news about crypto flying around the market right now. I'm not going to go over my full thesis on Coinbase. You may have strong feelings one way or another, but I have a short playlist that I've started with my few videos that I've made about Coinbase on my channel. You're welcome to take a look and kind of get a sense of what I believe about Coinbase from those videos. We're going to move on now to stock number 8 on our list, which is Adobe. Another one that I have about 3% allocation for right now, and it's showing I'm down. Adobe is a very solid, well-known stock. You can see that it's down drastically though. My average share price that I paid was $569, and at this point it's trading at $366, which is harsh. If you look at that chart, that hurts to watch right there. I only own 5 shares, and one of the reasons I haven't added more of Adobe yet is because really, you know, it's such a high quality company, it's such a high quality stock that it never goes on deep discount. It's still trading at a 36 PE ratio. You know, it's not a FANG stock, but it's right there behind them. It's a strong brand, it's a strong company with a strong name with really solid fundamentals, and it has consistent growth year after year. So it's just so tough to find a time when Adobe is on bargain prices. It's on sale. It's tough to find that, and so it always seems like there's a better deal out there to be buying than Adobe. All right, moving on. Number 7 on our list is LAC, Lithium Americas Corp. So if you haven't seen my video on Lithium Americas Corp, I actually have one. I'll put a card in the corner on that one right now, and I talk about my decision to own Lithium Americas in there, and I kind of do an overview, a little bit of an overview of the company itself, and I talk about the dumb money guys are the ones that, you know, really made that a stock that I had heard of and made it popular and really brought some light to Lithium Americas Corp. And I talk about my decision on why I will own it, but I'm not going to make it a huge position in my portfolio yet. And so if you go back and watch that video, I believe at the time I had 100 shares, and I believe my share price was probably around $30. I could be wrong. I haven't gone back to watch it. But you can see that today it's trading at $20 a share, and I have upped my position to 150 shares at an average price now of 26. So I've gradually added just a little bit, and part of the reason for that is because as we approach the time when I hope and believe that they're going to get the last of the restrictions removed for them to really begin building the infrastructure at Thacker Pass in Nevada on American soil to begin to lay the groundwork to have production and actually start to create revenue producing and selling lithium here in America. I think their stock price is really going to go shooting up. I could be wrong about that, but I want to go ahead and be building that position at least a little bit before the news gets out that things are in fact moving forward. It is still risky. They were a pre-revenue company for a long time, and they've just gotten things going at their location in South America, but it's a risk that I'm taking with a small amount of my capital. All right, next up is number 6 on our list, and that is Crocs. All right, Crocs is a company that I have owned and sold and owned and sold, and really honestly, over time, my conviction in Crocs has gotten stronger and stronger. And actually, if you look at the chart here, I'm nearing all-time highs of the amount of money that I've invested in Crocs. And that's reflected a little bit here in the average share price is $76 is what I've paid on average. But the price today is under $50 a share. And so here again, I am under. So if we take a look back at the holdings, you're going to see, most of my positions, probably like yours, if you've been investing in single stocks, probably most of yours are red as well. But you notice that I'm not concerned about this. I'm confident because I know these companies. I understand what I've invested in, and I'm comfortable with that. And while it doesn't feel good to see all that red, I'm okay because I understand what I'm investing in. And so, I'm down almost 37% on my Croc investment. But when you go and when you look at the company itself, PE ratio being at 4.2, each industry has their own range, and you've got to compare these to their peers and that kind of thing. It's similar to, the mining companies having these incredibly low PE ratios. But when I look at Crocs, it's a company that is very simple to understand. They make shoes. They're ugly shoes. They're comfortable shoes. And one of the things that's really hurt their stock price, along with the overall downfall of the overall stock market, especially growth stocks and tech stocks, one of the things that also contributed to their drop in share price was their choice to buy Hey Dudes as a brand. And I love Hey Dudes. I owned Hey Dudes before Crocs bought Hey Dudes. And if you haven't heard of them, they are a shoe that's a little more fashionable that are just as comfortable, in my opinion. The one caveat I'd offer to that is they're not designed for walking long distances or something like that. But you can wear them with almost anything, and they are a perfect acquisition for Crocs as a company. They were already making money, so it was instantly going to boost their revenue and their profits, and Crocs was able to take that brand, and now they're going to be able to sell it through their existing network of selling shoes all over the world. I just see this as a win-win, and I want more of it. And I think Crocs has been beaten down more than it really should be, and I think it has a great future, and I want to own more. And speaking of that, I realized today in prepping for this video that when I look at the next stock on my list, that's stock number 5, is Netflix. And I think about, you know what? I've got a mistake that I want to take care of here very soon. I want to own more Crocs than I do of Netflix. And that's how I look at my portfolio. If I see something that I realize, you know what, that's not right, I've got to do something about that. I either have to buy more Crocs or sell some Netflix, because that doesn't make sense to me, because it doesn't match how I believe the value of these companies are weighted in my portfolio. But Netflix, number 5 in my portfolio, another one that I'm drastically down on. If we go back to the holdings to check it, yeah, I'm down 57% on my shares of Netflix. Now, I have made a few videos on Netflix. You know, I made a video when I had about 20 shares, and I was trying to decide with the earnings call coming up, do I add more or do I not? And I decided I wanted to own 10 more shares of Netflix, and I decided I was going to buy 5 before earnings with a plan to buy 5 more after earnings. And after the last earnings call, that was a total disaster. I made another video, and I believe if you want to see it, it's the one with the shattered looking look on the Netflix thumbnail. And I talk about how I really felt like Netflix was struggling and failing at the time, and I believed it deserved that drop in price. And so you can see I've only added 1 more share at this point to my Netflix position. And the reason for that, I do see some signs that they want to make some changes that are good. They are making rumblings like they're going to do some of the things that I even talk about in my video that I believe they need to do like right away. And so that's good. And I like some of the content that I've seen come out on Netflix, but also the content that's been announced. I like some of the announcements that I've heard that Netflix is backing these different projects, and I think it could be really good. And I think long term Netflix is going to figure it out. I'm not ready to go real deep in it again at this point, but I will add a share or two as long as I see signs that they are coming along. So my average share price right now is $407, and the stock is trading today at about 175 bucks. So it has a long way to come back before I could count this one as a winner, but I do still have high hopes for Netflix. All right, next up, number 4 is Palantir. And you can see here that Palantir, I had allocated about 10% of my portfolio to be Palantir, but it has fallen and fallen and fallen. And today it trades around $9 a share, and my average price is almost double that still. And that's even having increased my position over time. If we go back to the holdings, you can see that my position is down about 47% still at this point. And Palantir is one of those stocks that I really believe the people that invest in Palantir are doing it on principle. And yes, we care about the future potential of the company and we care about the fundamentals, but you have to decide if you believe in the vision and you have to believe the principles of what Palantir is all about. Palantir is a love it or hate it kind of stock. Either you get it or you don't. You believe in it or you don't. You trust the company's vision and plan or you don't. Obviously, I'm a believer. I don't feel like I can do it justice in just a short blurb, so I'll just say I believe their software will be the AI platform that is the foundation for most governments and a large slice of big businesses in the Western world over the next decade. If you look at the dollar amounts that I've lost, this is my biggest money loser position right now. And yet I have high conviction. I am not concerned, and I see a lot of good signs that they're executing, that they are getting to where they need to be, that they are making good choices, and they're getting deals and creating partnerships, and I think they're headed in the right direction. All right, number 3 on our list is one of the only green stocks in my portfolio as far as my current holdings, and that is Activision Blizzard. And you can see that it's barely green. If you haven't seen my video on Activision and why I've decided to invest in it for a while, you can check out the video. I'll put the card in the corner. It really has to do with an arbitrage deal that Warren Buffett talked about, and it was kind of like oh, hello, why didn't I think of that kind of moment for me, that Microsoft has a deal to acquire Activision Blizzard at $95 a share just under a year from now. And I really see that deal going through. And so if I hold the stock for the next year, I'm looking at about a 20% increase, about a 20% gain on my money. And so when you look at it, the shares that I have so far, I've bought at an average price of $76.70, and the share price has sort of hovered in that $76 to $78 range the whole time I've held it. And I'm not very concerned about the PE ratio or the dividend. I guess I'll get a couple dollars of dividend at some point. But if the deal goes through and I still hold the stock, I cash in on that 20% return. Or if there's strong news that the deal is approved and is definitely going through, I would expect the share price to go up even closer to that $95. And maybe at that point I sell out. Or if there is news that the deal falls apart, I'm actually okay owning Activision Blizzard at $76 a share anyway. And I think the stock price would probably plummet if that news came out. And I would probably add to my position and wait for people to get over that news and eventually gradually sell out of the position. But my decision to allocate money to Activision Blizzard really had to do with the rest of the market going down. And I wanted to limit my downside. And I didn't just want to cash out, sell stocks, and be sitting on a pile of cash. This is another way I can possibly see some upside and limit how much money I'm losing in the other positions in my portfolio by taking anything that's questionable. I made a video earlier on about Shopify, and I was very comfortable with Shopify, but Shopify continued to go down. And I didn't sell right away, but on the news that Amazon was making some changes that I really thought was going to hurt Shopify even more. I still like Shopify, but I didn't want to hold it all this way down. And so taking companies like in that kind of situation, selling those shares, remember, no tax implications for me, I was able to allocate that money to something like Activision that wasn't going to lose. It was very, very unlikely to lose its value over the next 6 to 12 months. So at one point I had, I think about 15% of my portfolio was in Activision Blizzard. And just recently I've began selling out of a little bit of it at a time to beef up my Crocs position, my LAC gradually, small amounts, and then my Vale position. And I will probably continue to do that. Okay, up next we've got Google. Google is my number 2. And if you look at my position in Google, it is down as well. And my average share price is at 2,600 and it's trading under 2,200. And at a PE ratio of 20, it is just barely higher than the S&P 500 average, which is just unbelievable. This is one of the greatest companies in the world, and it is on sale. And so you can see that the amount that I've allocated to Google has continued to go up over the time that it's been going down. And if we go back to my holdings, I'm about 16% down on my position at this point. If you hadn't heard, Google's going to have a split coming up. I'll be interested to see how that affects the stock. It certainly shouldn't hurt it. It may boost the stock temporarily for a while. I don't see it as a really meaningful thing for Google in particular, but should be interesting to see. Obviously, I feel pretty strongly about YouTube, which is owned by Alphabet, the parent company for Google, but I also have a strong connection to and understanding of the Google business model. I own a small business that is heavily integrated with and dependent on Google advertising, and I just don't see Google losing their crown as the king of search for a long, long time. Alphabet also owns the Android platform, and while I like Apple as a company, I've been an Android user and advocate for years. Today, I use a Google 6 Pixel phone, and my last 3 phones before that were Samsungs that run on Android. It's a choice because I like the platform, I like the company, I like their products, I like their services. I understand their business, and I just see it as a fantastic company to invest in. All right, and the number one stock, I think I lost count along the way, but my number one position is Tesla, and it is just barely showing as a loss, but again, that can be deceiving. And I'm going to explain to you why. So Tesla, you can see that I own just about 56 shares right now. So the average share price is showing as 676, while the stock price is just under that. But here's the thing that you have to understand with these kind of brokerage accounts is, like in this situation, my true cost basis is so much lower. But what happens is I decided a while back that I wanted to own 50 shares of Tesla, and I was not going to sell those no matter where the stock price went. But when it dips down, I can't help but buy a few more shares. And so I buy, 3, 4, 5 shares, and then when the stock price goes up a bunch, I sell them gradually off. Kind of similar to the way Cathie Wood builds up and then trims her Tesla position when the stock price is bobbing along the stock chart. It's simply capturing a little bit more capital on the way. I'm happy to take that ride with Tesla anytime. And so the actual cost basis is kind of deceiving right here. But you can see on my $37,700 position, my net cash flow is $21,000. Okay, so I've actually gained $16,000 in profits on that $21,000. That is the net amount that I've invested in this position. But I want to talk about something now that we've talked about each of the positions. You can see that I think I didn't mention it. Google's about 16%, while my number one position, Tesla, is at 45%. Activision's 10%, and that's basically like my cash position. And all these other stocks are very small in comparison. Well, there's a couple of reasons for that. Number one, Tesla, I never anticipated it being such a large position in my portfolio, but when it grew so much over time, I simply couldn't part with such a great company. When I look around and I see Tesla just dominating, innovating, growing at just crazy numbers and going into so many different possible potential different directions that are complementary and just really going to expand, it's really incredibly hard for me to trade some of that capital, say I'm going to sell out of this Tesla and buy some more of these other companies. There's so much content out there on YouTube about Tesla, and I'm not a Tesla channel, but let me tell you, I'm a Tesla believer. I've been buying Tesla shares since Elon broke the window on the Cybertruck. That got my attention, and I'm glad it did. So that's it. That's my portfolio. That's my main portfolio. Now there's a couple things to keep in mind. I do have other brokerage accounts. I do have other smaller accounts, and I do have other assets. So one thing to keep in mind, don't turn around and say, well, this guy's crazy. He has 45% of his net worth in just Tesla. Well, you got to take it in perspective. You always have to consider, are there other variables? And in my case, this is a big part of my net worth, but it's by no means all of my net worth. And so when you average it all out, it's a much, much smaller position than 45%. And like I was saying, I do like the idea of keeping a very short list in my portfolio. Typically, my portfolio has been about 25 to 30 stocks. And I actually feel like this is a whole lot more healthy. And so for everyone watching this, if you really believe you have a stock that you believe strongly in that's not in my portfolio, I'd love for you to make a case for it. I'd love for you to talk about it in the comments down below. I read all the comments that people leave on my videos. I try to respond to them in ways that you can tell that I care, because I do. And if you feel strongly about a company that's not on my list, I'd like to hear about it. I'm sure many of them are companies that I've heard about before and looked at before, but maybe you have a perspective that I haven't thought about. Maybe you point out something that really makes it unique and different, and maybe you could convince me. Wouldn't it be cool if I ended up adding it to my portfolio before the next review? Again, there's not very many YouTube people that will show you this is what my actual balance is. And if you'd like to see more of that, smash the like button, because I'm not going to do it again until this video has 100 likes. So if you'd like to see that, make sure to do that before you go. But that's it for this video. Thanks for watching, and until next time, have a great day.